Welcome to Leading with Joy, Conversations with C-Suite Leaders series, where we engage with business leaders to hear their stories and to discuss their strategies on business building. Our goal is to help investors gain deeper insights into the individuals who lead these corporations and to understand their businesses better. Today, we are pleased to speak with Victor Tan, CEO and Executive of First REIT Management Limited, the manager of First REIT. Trained as an accountant, Victor left Parkway Holdings Limited as its financial controller to join First REIT Management Limited in 2008, where he was appointed as CFO in July 2008 and subsequently promoted to CEO in September 2017. Thank you for joining us today, Victor.
Thank you, Hazel. Thanks for having me.
So, we are now in a distinctly different period, with interest rates remaining elevated compared to the low rates of the past decade. In the property management industry, interest rate fluctuations are highly pertinent. So how will the higher for longer situation impact REITs in general, should the rate cuts continue to be delayed?
I think the current higher for longer interest rate environment is really a challenge for the S-REIT. More so, for us, if we want to continue our growth, continue our acquisition power, I think that's going to be very challenging, because of the higher interest rate. So a lot of time is also a bit challenging for us to gear up, because now that interest rate is so high, so it's also a bit challenging for us to look for yield accretive kind of acquisition. Consider our gearing is around 38%, although it's still below the statutory guideline of 50%. We can still gear up, but at this moment, in the current market, people once you cross the 40% hurdle, I think market is a bit wary, because of high interest rate, hence your finance cost will be a bit higher, and that will have impact on your distribution, going forward and things like that. So as you can see, quite a number of REITs, what they do now is basically trying to divest, trying to recycle their existing assets so they can actually try to reduce their borrowing. Hence, they will be able to reduce their borrowing costs. So I think this will be the strategy for most S-REIT, in this high interest rate environment.
So First REIT operates within the healthcare industry. How has the competitive landscape for healthcare REITs evolved over the years? What were the most pressing issues in the past, and going forth, how might things play out?
I would say the healthcare sector is a very resilient sector. Not exactly recession-proof, or not exactly kind of like pandemic-proof in the sense, because I think in the past, before this COVID hit us, right, we thought that healthcare is quite a resilient industry in the sense that, or recession kind of industry in the sense that good time, bad time, whether good economic situation or economy not so good, I think people still need to seek medical treatment if you are not well, if you fall sick and things like that. But we realized that there are actually certain non-essential elective kind of surgery you can actually delay. You don't actually have to go and seek treatment. If time are bad, you can actually delay some of these medical procedure. Hence, especially during pandemic, the time it kind of like hit the healthcare sector quite badly as well. The healthcare sector was kind of like impacted as well, during the pandemic, partly also because a lot of all this non-essential, all this elective surgery or procedure is actually being delayed, and kind of like pushback, and also of course government implementing certain measure, to curb the virus from spreading. That also have impacted the private healthcare industry as well, but having said that, right, post the COVID, once everything go back to near normal or normal, the pent-up demand will start to catch up. People will start to come back, because whatever procedure that's being delayed, I think they still need to actually get it rectified, get it resolved. Hence, they will start to to come back to seek medical treatment, to try to find relief, on their issue treatment. So hence, you'll see that there's a lot of pent-up demand post the pandemic, and you will see that a lot of these hospital business are back to normal, or even start to catch up and start to do well, post the pandemic. So I would say the healthcare industry is a very resilient industry. Yes, it may be impacted during bad economic time or during the pandemic, but it will catch up eventually, once the time come back and stuff like that. So I would say, and this healthcare is a very essential industry, which I said earlier on that, good time, bad time, when people fall sick, people will have to go and seek medical treatment. And it's an industry that government is also a bit concerned, because this is essential to the resident, to the people in the country. So government will usually implement very friendly policy that will help the industry, and also because of the as the population getting old, there will be a lot of new kind of like demand, in the aging population. I think Singapore is facing a different set of healthcare scenario because of the aging population, and there are other countries that may not have aging population, but they are also growing, especially in their developing economy, whereby they are growing their economy, and people starting to get more affluent. When people start to get more affluent, people expectation of the healthcare will also change. They will probably be a bit more concerned about their health. They will want to also start to look into their health, and where hence they will drive up demand for the healthcare sector.
Right. So the First REIT 2.0 growth strategy seeks to diversify into the developed markets and to increase the AUM in the developed markets to 50% by 2027. Currently, First REIT is riding on Singapore and Japan for its aging population, and Indonesia for its growing affluence and better life expectancy. Which other markets will you be looking at for further acquisitions? And additionally, what are the immediate priorities for First REIT over the next 2 to 3 years that investors can anticipate?
Yeah, okay. Since early 2021, right, we come up with this so-called 2.0 growth strategy, right? As you mentioned earlier, I think one of our key pillars is that we want to diversify into developed market. Okay, and we have set a target that at least 50% of our asset under management will be in developed market by FY 2027. Okay, so as of now, 25% of our asset under management is already in developed market. Okay, with 22% of asset in Japan, and then another 3% in Singapore, and of course the balance of the 75% now in Indonesia right now. So our immediate priority is actually to we are very focused in executing this 2.0 growth strategy. Okay, so we are actually looking at asset in Japan. Of course, Singapore is our base. We continue to look for asset in Singapore, although it's quite challenging to look at to look for healthcare asset in Singapore, because there's not many that is available. But nevertheless, we would still like to have some healthcare asset in Singapore, because we want to make Singapore our base country. And at the same time, another country that we are exploring is actually Australia. We are also looking at the healthcare market in Australia. In fact, we just did some market study. We commissioned a consultant to actually help us to do a more in-depth study into the Australia healthcare market. So Australian market is definitely one of the market that we are also be keen to work on.
Okay. So presently, First REIT generates more than 90% of its rental income from overseas. How might the potential ongoing depreciation of the Indonesian rupiah and the Japanese yen affect First REIT's rental income and distribution per unit when translated into SGD terms? 97% of our income is actually overseas. Only 3% in Singapore.
So the strong Sing dollar create a bit of headache for us. Indonesia currency didn't perform that badly, but unfortunately the Sing dollar is just a bit too strong. So what we actually did is that, when we restructure our leases, 3 years ago, we actually have a rental escalation. We have a minimum of 4.5% rental escalation, and this rental escalation is actually to mitigate some of this Forex volatility, especially on the rupiah currency side. Okay, and then of course we also need to do some hedging. So we also have been actively monitoring the currency, especially rupiah and also Japanese yen. At the right time, we actually will try to enter into some derivative to try to hedge this currency. Our policy is actually to hedge about 50% of the income that is coming back from Japan and also from Indonesia. Okay, so as of now, I think we are hedging around 30 to 40%, and we are monitoring the rate very closely. At the right price, we will try to hedge around 50% of our forex coming in from overseas. Yeah.
Okay, so the Indonesian properties, they continue to constitute a significant portion of First REIT's AUM. How might government healthcare policies, like the spread of health insurance, impact the business in the Indonesian market in particular?
I would say that the policy is actually definitely will help. And I think a couple of years ago, Indonesia government actually started this universal healthcare policy, and this is something like an insurance plan. I think it's quite similar to our Safe kind of policy. So when they actually implement this policy, they actually have an ambitious target that they want every citizen, every Indonesian, even resident in Indonesia to be able to sign up into this policy. And as of now, I think about 80-90% of the population is already under this policy. So that actually creates a lot of demand for healthcare, be it public or be it private healthcare. So this has actually benefited our hospital in Indonesia. In fact, some of our hospital in Indonesia was actually built specifically for this universal healthcare insurance scheme.
I see.
Yeah. So and obviously this will drive a lot of demand. I think in the past, right? I think we commissioned I think CBRE to did a study, in the Indonesia healthcare market. We realized that I think one of the issues that Indonesia is facing, is actually the lack of trust, on the healthcare personnel, in Indonesia. Hence, there's a group of people, especially those richer one, more affluent, they will be able to get out of Indonesia to seek medical treatment, elsewhere. But of course, if you are not that rich, you might have to force to actually stay back, to of course do your normal healthcare. But we also realize that Indonesia also has lack of healthcare facility. Hence, our group has been working very closely with the government to build more hospitals so that we can have more quality healthcare facility, for the Indonesia population to go into to seek medical treatment in some of these hospitals. At the same time, I think 2 years back or 2-3 years ago, I think Indonesia also started a new omnibus law, whereby they come up with certain regulation, to encourage foreign doctor or foreign healthcare company to be able to practice in Indonesia. That will also help to create some demand, and at the same time, they will also be able to come up with some regulation, to make sure that the Indonesian population will be able to trust, the healthcare system in Indonesia. As a result, all this, will lead to more people able to trust the healthcare system and able to access to the healthcare system in Indonesia. Hence, that will also help to drive more demand, into be it the public or the private hospital in Indonesia.
So in the past 5 years, First REIT's DPU has experienced a decline. When do you expect this decline to reverse and for the DPU to return to its previous peak level?
The DPU actually started to come out strongly in 2020, right, when we actually did the restructuring of the master lease agreement. And the reason why we did that is because that was actually during the COVID period.
Right.
When COVID hit us, I also shared earlier on that we are not, we are also susceptible to this pandemic and things like that. So pandemic also has kind of like impacted us, So as a result of this pandemic, right, it kind of like impacted our tenant very badly, and our tenant no longer is able to pay us the kind of rental. Hence, they actually come to us to restructure the master lease agreement. This is the reason why our DPU in 2021, kind of like fall quite a bit. Okay, and that's the year that we actually reset our DPU. Okay, and post the restructuring of our master leases, first year our DPU kind of like improved, largely also because we come out with this First REIT 2.0 growth strategy. Hence we have moved to developed market. We enter Japan, we acquire 4 nursing home in Japan, and the Japan portfolio is able to provide very stable rental income to us. Hence, we are able to deliver slightly better result in the first year after we have restructured our leases. But then subsequently, I think the last 2 years, partly also because of the higher interest rate environment, hence our finance cost is a bit higher. At the same time, we are also impacted by the foreign currency depreciation. I think our main goal is that we want to continue to be able to execute this 2.0 growth strategy. So we want to have more asset to be in the developed market, so that when we have more asset in the developed market, we'll be able to derive more stable rental income from this market, and hopefully by doing so, we'll be able to dish out very, very stable dividend going forward.
Okay. So similarly for the net asset value per unit, when do you anticipate the decline to reverse?
Again, is all linked to the currency issue that we have,
Right.
And our net asset value kind of like decline also because of the Forex exposure that we have in Indonesia and also in Japan, more so in Japan, because the Japan currency also has kind of like tumbled quite a fair bit, over the last 2 years or so. Like I said earlier on, if we continue to focus on, diversifying our asset portfolio into developed market, I think that would actually help us to be able to divide very stable current rental income, from the developed country. Hopefully by doing so, we will be able to improve our NAV going forward.
Okay.
Yeah.
So under the high interest rate environment that we are currently in right now, the cost of debt for First REIT has increased from 3.7% in FY 2022 to 5% in FY 2023. Are you able to provide some illustrations if interest rate is to reduce or rise, and what will be the impact on the cost of debt and on the DP?
Okay, the interest rate has actually gone up from 3.7% to 5%. This was actually due to the fact that we have fixed, some of the loan. Okay, we've actually fixed using the derivatives, so we kind of like swap it from floating to fixed, and the reason is because of the higher interest rate environment, we want to have more of our debt to be on a fixed or hedge basis. So as of now, 87% of our total debt is already on fixed or hedge basis. Hence, only 13% of our loan is susceptible to higher interest rate. So I think we also have done some calculation. Every 100 basis point increase in the rate will only have about 0.6 million impact on our distributable amount. 0.6 million over 50 million is not a very big number. So we don't foresee the high interest rate will have a big impact on our distribution going forward.
So I'm a firm believer that setting the right tone at the top is crucial for effectively managing a corporation.
Yeah.
Could you also share more about the type of company culture that you aim to cultivate at First REIT?
So at First REIT Management Limited, right, in line with the OUE group, right, we want to develop a culture of transformational thinking, anchored on values such as respecting each other, putting our heart into all we do, stepping up and take ownership, supporting one another to achieve a common goal, and looking at things differently to achieve a positive change.
So what do you think is unique about being the CEO of First REIT?
Okay, as our name implies, right, First REIT, right, we are the first healthcare REIT to be listed in Singapore Stock Exchange in December 2006. Our name in Chinese is actually called Xian Feng. Okay. Xian Feng, that means is pioneer. So we are actually the pioneer of quite a number of things in the market. For instance, 2 years ago, we are the first Singapore REITs to issue a social bond. This is actually with CGIF, which is a trust fund of the Asia Development Bank. Okay, and we are also the first Singapore REIT to change sponsor and also change trustee. Okay, yeah. And over the years, I've actually built a very good and stable team so that they will be able to join us, to venture into the new frontier.
And very lastly, are there any strategies or practices that you implement to cultivate a happy work environment, especially in high-pressure situations typical in the C-suite roles?
Instead of happy environment, right? Maybe I like to borrow your term joyful or joy in that sense okay, the difference between joy and happiness is that joy is more like inner, your inner peace, and it's more permanent. Whereas happiness is more like due to external kind of environment and it's more temporary. So I would prefer that maybe our company culture could be a joyful culture, whereby people intrinsically will feel the kind of joy when they come to work, and it would be because they find that no matter what role you are in the company, every role is important. Doesn't mean that you are at the top, you are the most important person. I don't think so. I think every person in the company is important. To the company per se, and every one of us has a role to play.
Thank you, Victor, for sharing your perspectives and outlining the future direction for First REIT. It's great speaking with you.
Thank you so much, Hazel. Thanks for having me.